Why is Michael Burry selling everything? Michael Burry, well known from The Big Short, has sold out of his entire portfolio of stocks over the last 3 months. He has been predicting a crash for over a year, and now he's bet his entire $300 million portfolio on this thesis. But why should we listen to Michael Burry? Sensational financial pundits have been predicting a crash for over a decade now. How is Michael Burry any different? The thing is, history tells us Michael Burry is seldom wrong. He famously predicted the 2008 market crash.
Not in generations has Wall Street absorbed the number of body blows it took today.
And profited over $800 million as a result of it. He also predicted the dot-com bubble of 2001 and made positive returns while the whole market was down 20, 30, 40%. So why is he selling everything in 2022? We can decipher his $300 million bet by going through his deleted tweets. With the market back up from its lowest lows, many people are calling for a new bull market. Michael Burry heavily disagrees. He says, NASDAQ, a bull market because it's up 20% off its low? Who makes this stuff up? After 2000, the NASDAQ did that 7 times as it fell 78% to its 2002 low. Looking at this chart from the 2000s, it's clear the market ran up 20% or more, 4 or 5 times, even as it fell 78% from its highs. You can see that in any major market decline, there will be times where the market moves up substantially, but that doesn't mean it's over. So what's really causing this crash? We can see that it's happening. We can see that the market's down 25%. But what is the underlying cause of this massive crash that Burry is calling for? According to Burry, the post-COVID boom in spending is coming to an end very soon. Given the trend in lower consumer savings month over month, he's expecting consumers to start feeling the crunch this Christmas. He uses the current savings rate trend to figure out when the economy will start to feel the worst of the spending slowdown. In this tweet, Michael Burry is charting total US personal savings over GDP, and the red line is the all-time low at 1.5%, set in July of 2005. At the last 12 months rate of depletion of savings, Michael Burry believes we could hit that level between September and December this year. At the current rate, it looks like December is when consumers will hit their all-time low savings rate, just borrowing more time until the next recession. But you might be asking, how does the amount you and I save cause a recession? First, we have to understand that 70% of the US economy is dependent on US consumer spending. That means the economy runs on how much you and I choose to buy every day. So any slight change in the US economy can have a huge domino effect across the entire economy. Michael Burry is betting that less money in our savings will lead to less money being spent. So does lower savings really mean less spending? Think of it this way. If the savings rate reaches an all-time low of 1.5% on average, that means there will be a much larger amount of Americans that actually have a negative savings rate. If we use a normal distribution, you'll see that as the savings rate moves down, a much larger portion of Americans are going to be entering negative savings territory. Negative savings means Americans are going into debt. As Burry said, it's time for borrowing. And this debt will start to show up in consumer spending, especially on larger ticket items like cars and phones. We're already starting to see this play out. According to Deloitte, 56% of Americans are tightening up spending as compared to 36% in March of last year. That means there's another 20% of Americans that are likely to spend less than they did last Christmas. How does this lower spending in the future lead to the kind of market crash that Michael Burry is talking about? Michael Burry is calling for the S&P to fall nearly 50%. This is where the stars have aligned against the US economy. If we look back at that savings rate graph, US savings were at all-time highs in 2020 and early 2021. Lots of Americans were feeling great about their financial prospects. So Americans took all that cash that they received from the COVID stimulus and plowed that back into the economy. This influx of cash led to what we saw in crypto with a massive bubble of Bitcoin going up to $70,000 per coin, as well as some of the speculative investing that led to the meme stocks of GameStop and Bed Bath & Beyond. And record spending on things like iPhones and cars, where after iPhone and Apple had been stagnant in sales for a few years, they saw a 25% 8% bump in revenues. Now we can look at these numbers and see last holiday season, only about 40% of Americans were really worried about spending money. Now that number's up to 56% and still moving higher. In other words, expect socks for Christmas instead of a new Nintendo Switch. Now, if this happens across the board, we can expect a much weaker holiday season than we saw last year. But that's not all, folks, because this time around, US companies are not prepared for it. This lower amount of spending is actually coming after a period of really high spending. Given all the supply constraints and long periods of backlog, US companies have been building up inventory, preparing for this Christmas, because they're worried about losing out on possible sales like they did last year. And this extra inventory costs money and time to stock. So much so that many retailers are telling customers to keep the stuff that they want to return while they still refund them, because they don't want to spend the money to restock it. Retailers like Target and Walmart are doing this, whereas before this was really only done by Amazon, because they had higher restocking fees because you had to ship everything back and they would cover that cost. With expectations so high after last year's amazing demand in the economy, Michael Burry's betting companies are going to get caught on the wrong foot this December. So you might be wondering, stocks are already down 20%. What's going to make them really go down that much more? Michael Burry explains this in one of these tweets. Adjusted for inflation, 2022 first half S&P 500 was down 25 to 26%. And the NASDAQ was down 34 to 35%. Bitcoin was down around 65%. That was just multiple compression. Next up is earnings compression. So we're only maybe halfway there. Take a look at Apple, Burry's favorite short bet at the moment. Apple is expecting to sustain iPhone sales in 2022, even as they expect the market to slow. The company has asked suppliers to make 90 million units. Apple believes that their customers won't be affected by the slowdown. Burry is betting against them. So Burry is really saying that crashes come in two stages. One is multiple compression, where the market starts to wonder if stocks are really a good place to have their money at the moment. And so they reduce the valuation of these companies and their expected growth. Two is earnings coming down. So when there's a recession in consumer spending, the earnings also come down, and all of a sudden the stocks need to come down with them to stay at the same valuation. Right now, we haven't seen the earnings come down. The consumer spending slowdown is coming up, according to Burry. As the earnings do come down, as you can see in this chart, you'll see that the price of these companies will also come down. To sustain the same price to earnings ratio, the company stock will have to come down if the earnings come down. Now that we understand why Michael Burry sold everything, the question is, how is he going to make money if he sold everything? So the clue to this can be seen by what he owned up until very recently. Specifically, Michael Burry had a really large amount of his fund in stock options, something that you almost never see with professional investors. It's the type of thing you see on Wall Street bets. Burry had a whopping 20% of his portfolio betting against Apple through what looked like long-dated put options. Put options are the option to put a stock to somebody else at a set price at some time in the future. So Burry was expecting Apple stock to come down so far that he would be able to put Apple stock to somebody else at a price close to where it was when he bought it and profit off of that change. It's a way to short a stock without shorting it directly. The risk there is that put options become worthless if things don't happen in the time that you're expecting them to happen. Based on Michael Burry's tweets, he's still bearish on Apple, despite selling out of his put options. Apple isn't all that will be affected though. Burry may have found a better way to play this recession, the way he did in 2008 with the credit default swaps, where each $1 that he put down, he was able to make $8 on those bets. If you're looking for a way to invest through this recession, check out my video on how Chuck Akre beat the market for 30 plus years while having lower risk than the market itself on his investments.